We are living in the dumbest stock market in history. And in today's video, we'll explain the dangers and how to avoid getting caught up when this thing ultimately does end up coming down. From flankinvesting.com, this is Money Grooves, the show for intelligent investing. I'm David. I've been investing for over 10 years.
And I'm Elliot, and I'm a big fan of avoiding falling objects like this market.
Elliot, do you know the difference between passive and active investing?
Yeah, I think I do. Active investing is kind of what we do on Flank, where we're researching companies, knowing what we're investing in, and really putting in the time and effort to understand our investments. Whereas passive investing is when we just give the money and somebody else does it for us, and we don't really know what we're investing in.
Yeah, that's exactly right. And the person could be a person if you're doing a fund manager, or it could be an ETF or an index fund or a mutual fund. It could be a whole host of things. But yeah, passive investing means you're just giving your money away, you're dollar cost averaging. You're just kind of going like that, right?
Yeah. And I've heard you talk a lot about dollar cost averaging, so that makes a lot of sense.
Yeah, and I personally dollar cost average the S&P. So I have an active arm and I have a passive arm in my investing. One of the most harrowing phrases from all of investing, and actually played at the beginning of The Big Short, is it ain't what you don't know that gets you in trouble. It's what you know for sure that just ain't so. And it's a Mark Twain quote, but it applies to the market. We've all agreed that dollar cost averaging the S&P 500 is a good idea. But now, according to a research report from St. James Investment Company, passive investing now makes up 53% of the total stock market.
Wow.
That's like being on a plane and learning as you're in the air that there's no one in the pilot seat.
Yeah. Yeah, right. That the plane is flying itself.
Yeah. Index funds were created by Jack Bogle back in like 1975 timeframe. And his idea was really cool. He said, instead of trying to find the needle in the haystack, trying to find that individual company, you can just buy the haystack. And so when you buy the S&P 500, you're just betting that the 500 best and largest companies in the U.S. will grow.
Pretty good bet.
For the last 100 years, it's been a wonderful bet. And I would guess for the next 100 years, it's going to be a good bet as well.
Yeah.
But just like when we do active investing, valuations matter. And I'll show you how crazy overvalued the market that we are living in today is.
Yeah. So are you saying that if I'm investing in an ETF like QQQ, for example, that I'm potentially investing in a whole bunch of overvalued companies?
Yeah, actually, kind of.
Wow.
So my favorite way, my favorite indicator to see if the stock market is overvalued or not, and it's Buffett's as well, is called the Buffett indicator.
Aptly named?
Yeah, aptly named, because he came up with it, which is cool. And I like it because it takes the Wilshire 5000. So instead of S&P 500 is 500 companies, the Wilshire 5000 is like 5,000 companies.
I've never heard of this.
Yeah. And
Cool.
And it takes those 5,000 companies and divides it by GDP. And then that ratio tells you where valuations stand at any given time. So you can see the average since 1980 has been 88%. And this chart only goes to 2022. And you can see that, right before the dotcom bubble, we got up to right below 150%, right? And then right before 2007, we were getting up a little higher as well. And then but really the big asset inflation value here was in real estate. This is looking at the stock market. So that's why this wasn't as crazy in 2008. But then right after everything came back from COVID and we had the inflation period, that's when we saw this huge jump. And so, like I said, this ends in 2022. Right now, it is over 200%.
Wow.
Which
crazy.
Buffett says if it's over 190%, you're in dangerous territory.
Yeah.
So that's the first indicator that the market's overvalued. Another way to show how expensive the market is to look at the Shiller PE ratio. This guy won a Nobel Prize in economics for figuring this out, but really just got to understand that this is the PE ratio for the entire market.
Okay.
And so you can see right now the PE ratio is 39 times earnings, which the mean is normally around 17.
Wow. And
And the max that it ever hit was 44.19. And we're getting really kind of close to that. We're at 39 and the highest was 44. So, and then the other time it crashed was right before the 1929 crash. This is Black Tuesday. I'm hovering over right here.
Do you know what the cause of the 1999 spike was?
The internet stock bubble. And what rhymes with Shmei I that could possibly be a bubble?
Yikes.
Everyone has access to all this data. So everyone knows that the market is highly valued right now.
Right.
So what does the bet become then? The bet becomes, the bet that is running Wall Street is that AI is going to increase productivity, right? There are only two ways to increase GDP. Productivity growth or population growth. The market is betting that AI will unlock a whole new level of productivity. But we got some dangerous we got some dangerous writing on the wall. A report from MIT found that 95% of generative AI pilots at large corporations are failing to increase productivity at all. Wow. A non-noticeable increase in productivity.
Wow.
So does that mean a crash is coming?
I'm going to say no.
I'm going to say yes. A crash, there's one thing I'm certain about. A market crash will happen again.
Okay.
Do I know when? I have no idea. and I don't, I know where valuations stand. I'm looking for companies to buy all the time.
Sure.
But I'm not really thinking about, but I also know that the tide water is really high right now. Yeah. So it's hard to find a good deal. And when the market crashes, then valuations are super low. And it's really, where I look now, if I look at 20 companies right now, I might find one. With the market crash, if I look at, 2 companies, I'll probably find one.
Yeah. So David, when you say a crash, are you referring to something catastrophic or something that is just a significant dip in the market? Like, are we talking like 2008 level market crash or something less significant?
Yeah. So when Jamie Dimon was asked what is the definition of a recession, he said something that happens every 7 years was his answer before Congress.
Wow.
So it's we should be normally expecting a crash every 7 years or so. That's what history has told us.
Sure.
We have gone a long time without a crash. You could count COVID, but that was a little bit different, and the government spent its way out of it, basically.
Right.
And so you could say the last real economic crash we've had, the last economic recession we've had, was back for the Great Financial Crisis back in 2008. And so now we've kind of skipped our every 7 years.
Sure. Now we're on thin ice.
We're on thin ice. Yeah. And it's important to say that anyone under the age of 35 has never experienced a true market crash, myself included. I'm 34. I just turned 34 this week.
Happy birthday.
Week. Yeah, thank you. Just to show how scary a recession is, if you invested in the NASDAQ 100, QQQ, at the start of 2000, you were absolutely right that technology was going to change the world.
Yeah.
But you lost 3/4 of your money over the next 3 years. It went down 75%.
Yeah.
By the time Steve Jobs was unveiling the iPhone in 2007, you still hadn't been made whole. Wow. It would take a couple months after that for you to have recouped your money if you invested at that point.
Wow.
And there are a lot of parallels that you could draw between the AI bubble and the dotcom bubble. There's no question about that to me. And I think it's really important to say, just like the dotcom bubble, AI will change the world. Like I don't have a question on that. Just like the internet changed the world.
For sure. Yeah.
But there's a really cool law, and it's called Amara's law. And it says, and Amara's law is, we tend to overestimate the effect of a technology in the short run and underestimate the effect in the long run.
Yeah.
I think AI will change everything, but over the short term, it's not going to be overnight.
And it's really difficult a lot of times to predict just how as well, right? The ways in which.
Yeah, exactly.
So David, do you think that if the recession were to happen, what industries do you think would be most impacted, and what industries or sectors do you think would be safest?
It's tech. Yeah, tech would get nuked.
Tech would get nuked?
Tech has the highest multiples right now. If you look at an S&P 500 heat map, you can see that like Nvidia is trading at 51 times earnings, so that's expensive. 37 times, and this means it's all room to fall, because you can see if you give me a company that's trading at 1 times earnings, I'm going to buy that company in a heartbeat, because I will be just off.
They're trading exactly where they're at.
Yeah, well, no, that would mean that the earnings, the yield of the company, I'll be made whole in 1 year, because it's literally just the net income that company is producing would return my investment in 1 year.
Yeah.
But then if we look at like Exxon Mobil, it's trading at a 15 multiple, so it's like almost a third of what Microsoft's multiple is right now. Yeah. But yeah, you would see a broad sector decline, but just like we saw in the dot-com bubble, tech will get hit the hardest.
Interesting. So then all those index funds also that are built on tech, like QQQ is heavy tech. I know that some of the Vanguard ones I talked about in previous episodes, also heavy tech. Those would also fall pretty significantly then as well.
Yeah, yeah. And it's important to say, I think that QQQ in 30 years will be worth a lot more than it's worth today.
Sure, yeah.
But I think that, we've seen a big run up in the last 3 years across the S&P 500 and the NASDAQ.
Right.
And it's, I saw a report from Goldman Sachs that said when you've had 3 strong years like we've had, the returns after that have been, minuscule. Sure. It's like there's been literally 0 times in history that we've had that like the 5 years after a big run up like this, we've had the same amount of returns. Like we've had positive returns those next years.
Interesting. What's the action for you? What are you going to do?
Yeah. And to best answer that, I'm going to turn to a legendary investor.
Okay.
Have you heard of Howard Marks before?
I have not.
Howard Marks is awesome. He runs Oak Tree Capital Management. He's done it. He's like old like Buffett. And actually, speaking of Buffett, Buffett said that when he receives a investment memo from Howard Marks in the mail, it's the first thing he reads.
Oh, nice.
So this guy, like this, he's got the goat, reading his stuff. So this is really good. So he released a memo called The Calculus of Value, and we'll link to it at the end of this show. But I'm going to give you one of the punchlines here. All right, Howard writes, the existence of overvaluation can never be proved, and there's no reason to think that the conditions discussed above imply there will be a correction anytime soon. But taken together, they tell me the stock market has moved from elevated to worrisome. So what should you do about it? And then he gives a really fun analogy, and I wanted to include it here. And you know what DEFCON 5 is?
Yeah.
So that's like it's like nuclear readiness. So when we're at DEFCON 4, that means we need to be ready to respond to a nuclear strike. The U.S. needs to be ready to respond to a nuclear strike. And if we're at DEFCON 1, that means like there are literally nukes in the air. And so he took that idea and created Investcons. And so if you're at Investcon 6, you stop buying stocks. Investcon 5, you reduce aggressive holdings and increase defensive holdings. So sell like Palantir and buy like Waste Management.
Sure.
Sell off, and Investcon 4, sell off remaining aggressive holdings. Investcon 3, trim defensive holdings as well. 2, eliminate all holdings. 1, go short.
So for number 2, you would literally eliminate your entire portfolio?
Yeah.
Sell your entire portfolio?
Yeah.
Wow.
But he also says, and he clarifies here, that's a horrible idea, right? And so he says,
I was gonna say,
yeah. He says, in my view, it's essentially impossible to reasonably reach the degree of certainty needed to implement Investcons 3, 2, or 1. Don't do that, guys. That's
Don't do
bad
that
idea. But he said, I have no problem thinking that it's time for Investcon 5.
Sure.
So reducing aggressive holdings. So now is not the time to be buying fart coin, guys.
Is there ever a time to buy Fartcoin?
No. Now's not the time to be buying Palantir.
Right. I was going to say, like, these big name tech companies, Nvidia, Palantir, Apple, like maybe not time to start your investment journey with Palantir.
Yeah, I mean, just to really highlight that, the hammer in that, if we look at Palantir, we can see their PE ratio is 550.
Wow, that is absurd.
Anything above 20 in the school I come from, value investing, anything above 20 is expensive.
Yeah,
550 is bonkers.
Yeah,
and so that like. And disclosure, I'm a Palantir shareholder, but I bought in 2021, and I have been writing covered call. I've been selling covered calls, which is an option strategy that it's the only option strategy you should be doing. But it basically means I'm getting paid every month when it doesn't sell, and so we made a video where we talk about how I turned my Palantir stocks into a dividend stock.
Why don't you share this information with me?
I made
a
a video to the open internet.
Can we talk about what the internet is?
Yeah.
You still haven't answered my question though. What are you gonna do?
Yeah, I'm doing what I always do. So right now I have a lot of T-bills. So I have a lot of short-term government bonds. So I have dry powder. I'm ready to deploy when I find something. And we made a video on it last week. I'm looking at buying a grocery store right now. I'm looking at buying a bodega.
Investing small.
Yeah, I'm looking at some, and because bodegas, if it's the right price, we're still in negotiations and in diligence. But if it's the right price, then that's a very safe investment.
Yeah.
And I haven't bought a public stock. I'm still dollar cost averaging in the S&P 500, but I haven't bought a stock since I bought Robinhood in April. So, but okay. I'm always looking. Like you guys will see me on Flank. I'm still studying public companies all the time because there are deals out there. They're just harder and harder to find when the overall valuations are this high.
Sure.
And you build the muscle by doing it when valuations are high.
Right.
Because then when you see all your favorite stocks go on sale,
right,
you get really excited. And that's one of the best things you can do in investing is be greedy when others are fearful.
Yeah.
And fearful when others are greedy. And right now, others are greedy.
Get ready for a fire sale, everybody.
Hopefully soon. That's all for this one. Thank you so much for watching. You'll see that video talking about how I turned my Palantir stock into a dividend stock floating somewhere over my head. And if you want to learn more about what we're doing at flankinvesting.com, you can visit the site there. Make sure you say hi if you do. I respond to every post, every comment. Love to see you. Thanks again, and we'll see you in the next one.
Thanks, everybody.